just to quickly set up a trade, we've got, a decent risk reward here because we're saying a $1-ish, $1.20 stop. And we've got, at least kind of $4, maybe even $5 per barrel, just a very simple kind of 4-to-1 trade there, risk reward basis. But you can even enhance that because we've got so far to go, we think, that you've probably got a scale in there, right? So if you scale in, you're basically, if you're going to double your volume from your initial entry, then what you're going to do is use the money from the move you've just made. So let's say your scaling point is kind of like $1.50 lower to around about 5. Then you've got basically the money you've made from 350 to 5 plus the initial $1,000 or whatever you risked to begin with, and you add them together for this new entry price, and that's what gives you the leverage. So suddenly you've got double the risk on, but because you're in the money, you're okay with that, and you can keep the same stop or even a slightly higher stop. And so you've completely protected your capital. So suddenly your $1,000 that you were looking to make 4-to-1 on, you could suddenly make 8-to-1 on, right? Or 10-to-1 on, which is what makes these kind of setting up your trades so powerful, right? If you do this well, yeah, that's a really good setup to basically sell into a trending trade, wide stop, one scale in, and target probably around 750, minus 750 to even 8. And I would say at that point, you've made probably like $4 on an average entry. And you want to maybe take off half at your kind of reasonable target limit, but you do want to run the rest, right? In a trending trade, markets tend to be moving from an overbought to oversold scenario all the time. So you don't want to miss that kind of oversold part. So you want to run that winner. How do you run a winner? Well, yeah, you take some off and you basically ratchet down your stop in this scenario. So you would be moving your stop, like basically, there's a number of ways you can do it, but I always like the daily ratchet stop. So you would basically say, I don't know, it's a trailing stop of, let's say, $2. And then if it closes a bit higher, let's say it goes 50 cents higher, you keep the stop at like 150 and you keep ratcheting down to like the new lows set every day. And it basically squeezes your trade. So if the market's like lowers down in volatility, the ratcheting stop will catch up and basically stop you out at some point, which is kind of what you want if you're just letting the market do its thing. But at the same time, if it keeps running, it allows you to stay in the trade. So I really like ratcheting stop losses, and I think I'll do a video on that later on. But either way, that's a pretty good setup.